you're like a lot of people, then you've heard of Roth conversions before. But as a financial planner working with entrepreneurs and retirees, I have seen so many ways that the Roth conversion can go wrong, and it is a terrible idea if you jump in headfirst without having a plan, or at least having some idea of what it is that you're doing. And in today's video, we're going to go through 3 big mistakes that I see when people attempt a Roth conversion for the first time. Hi, I'm John Norbert, and welcome to the Financial Prof series. So when you start thinking about Roth conversions for the first time, it's usually for one of a few different reasons. Maybe you've had a lower than normal income year and you want to take advantage of it from a tax perspective. Or maybe you're between jobs and you realize, well, I've got a large IRA or 401k out there and I want to make sure I don't face a ton of RMDs or required minimum distributions when I retire. Or maybe as an entrepreneur, your cash flow is a little bit lumpy and you realize, hey, I'm on a path and that path is headed up, and I want to make sure that when I do get time to enjoy my money, at least a good chunk of it, or perhaps even all of it, is going to be tax-free. And the Roth IRA can be a great tool to help accomplish that. But whatever the reason, when attempting the Roth conversion for the first time, like we talked about, there are a number of things that can potentially go wrong. So I want to talk about 3 hidden gotchas or mistakes that I see in the Roth conversion strategy. And also, if you stick around to the end, I'm going to go with a bonus mistake or bonus gotcha that you're going to want to make sure you know about. Okay, so if we're going to talk about Roth conversions, it's probably helpful to have a little definition first, or refresher, of what a Roth conversion is. So what is a Roth conversion? Well, imagine as if you had 2 buckets, right? And over on the bucket here, it's pre-tax money. Anything we take out of this bucket, we didn't have to pay taxes on when we put it in, when we poured it into this bucket, but we'll have to pay taxes whenever we pour money out of that bucket, right? But over here, this is our tax-free Roth bucket. Anything that's in this bucket, we didn't get any kind of deduction on when we put it in, but that also means that while it grows, it's going to grow tax-free, and when we dump it out again, when we pour that money out, for whatever reason it might be, a vacation, a huge purchase, or maybe some financial outlay that we don't want to have taxes on, that's going to be tax-free, right? Roth means tax-free distributions, whereas traditional or pre-tax means tax deduction typically when you put it in, right? A Roth conversion is when you pour money directly from this pre-tax or traditional bucket into that Roth bucket, right? Roth conversion means you're converting it from your pre-tax IRA or 401k typically to a post-tax Roth IRA or Roth 401k. And the biggest benefit of doing so, of course, is because once it comes out, again, it's tax-free. However, when doing a Roth conversion, it's in the act of pouring that money from bucket A to bucket B, if you will, that the tax comes into play. Because that taxation in the conversion usually occurs, always occurs, in the year that you do that conversion. All right, so now that we have an idea of what a Roth conversion is, a quick refresher, let's talk a little bit about these 3 big mistakes. All right, so the first mistake. This is one of those gotchas that can occur pretty much no matter what age you are. Unlike the next one we're going to talk about, which is another big mistake I see, particularly when people are getting ready to retire, which is when you don't want to make these mistakes. Mistake number 1 can apply really to anyone who has decided to make a Roth conversion, and I have also seen this come into play when people don't know anything about it. What is it? It's NIT. No, it's not that annoying little insect that buzzes in your ear around this time of year. NIT stands for Net Investment Income Tax. NIT comes into play on incomes of over $200,000, that is if you're single, or if you're married, incomes over $250,000. And by income, I'm talking about modified adjusted gross income, right? And it is a 3.8% on your tax on your investment income if your modified adjusted gross income is above those levels. Again, $200K for single filers, $250K for married filers here in 2025. This is not something that is directly attributed to the amount you're converting, but if you convert a large amount from your traditional to your Roth, it can now trigger that NIT or net investment income tax to come into play on any investment income that's part of your whole income picture. So let's say that you make $200,000 per year and you're right at that level, but then you decide, okay, now I'm going to make a $100,000 Roth conversion on top of that. Well, if you already have $200,000 worth of income and then you make $100,000 of Roth conversion on top of that, now your modified adjusted gross income is $300,000. So whatever portion now of that $300,000 is investment income is going to get an extra 3.8% tax added to it. This can be dividends, it can be capital gains, it can be, here's a big one by the way, this is one that any of my real estate investors or real estate agents watching are probably going to want to be aware of. NIT can also affect rental income because that is typically considered investment income, right? So again, big mistake number one, NIT. Know what it is, know how to calculate it, or at least know that it exists and how to make sure you're planning for it if you're considering a Roth conversion, especially a larger one. Okay, so now that we've talked about mistake number one, let's dive into mistake number two. And this is a big one because it generally comes into play as you're getting ready for retirement. It also comes into play in a very big area of retirement, which is healthcare. Obviously, as we age, our bodies aren't what they once were, and we tend to spend more and more and more on healthcare. It just is what it is. It's a fact of life, right? But as a famous nobleman of Florin once said, if you haven't got your health, you haven't got anything. Which is why we want to make sure that when we're thinking about mistake number two, we're fully aware of what it is, how to avoid it, or if we're ready to take that burden on, that we're at least planning for it. What is it? Mistake number two is Irma. No, I'm not talking about your great aunt who liked to bring pies to Thanksgiving every year. Irma stands for Income-Related Monthly Adjustment Amount, and it has to do with your Medicare premiums. So if you make over a certain amount, you're going to see an adjustment relative to that on your Medicare premiums. Now, you're not going to notice it right away. It actually only takes effect 2 years after you recognize that income, right? So when does it kick in? Well, right now in 2025, for single filers, it kicks in if you have modified adjusted gross income in excess of $106,000. Or if you're a married filer, then it's going to be $212,000, right? Pretty easy to remember because single is half of the married amount. What does it apply to? Well, it applies specifically to Medicare Parts B and D. And essentially, if your income, your modified adjusted gross income is above those levels, again, $106K for single, $212K for married filing jointly, you're going to notice that the amount you pay in subsequent years for Medicare is going to be substantially higher depending on how much your IRMA is. A quick example, if let's just say you're making a Roth conversion and it tends to be a rather large one, let's just say 6 digits. It could kick your monthly premium for Part B of Medicare up from $185 to as much as $628.90. And because it only kicks in 2 years after you've gotten that income already, it can be a big kick in the pants surprise when, maybe you did that Roth conversion for whatever reason a year or two before you decided to retire, or a year or two before you turned age 65, and then you decided to, retire, you hit 65, you apply for Medicare, the whole 9 yards, and now all of a sudden you're getting this huge increase in premiums, even though you didn't have a huge increase in income necessarily that year. And it's because of the activity from previous years, again, like that Roth conversion. Right, so now that we talked about mistake number two, which is IRMA, or not calculating for IRMA, let's talk about mistake number three. This is a big one that has actually happened to people that I personally know. They were not at the time clients, but they have since become clients. They were deciding to do a great big Roth conversion. Reason being, they had a large drop in income planned, and they wanted to take advantage of that, so they were taking a huge chunk out of their pre-tax assets and converting that to Roth. And when they did so in December. Now, here's what happened. It was early December. They were thinking about making cookies, sitting down with family, decorating the Christmas tree. And after that meeting with the financial advisor, I'm willing to guess that the idea of the Roth conversion they agreed to at that point completely left their minds, thinking that they could pick it up again in spring when taxes are due. But because it was a larger than normal Roth conversion, tens of, if not hundreds of thousands of dollars that we're talking here, it ended up triggering a required quarterly estimated payment on their taxes. In other words, because that income from the IRS's eyes is untaxed income, in other words, it's not having taxes withheld from it through like a job as you normally would, it's going to require, if it's large enough, that you make quarterly estimated payments for that amount that the IRS is seeing as income. Because the $100,000 Roth conversion is, in the IRS's eyes, $100,000 of income that needs to be taxed. So in my client's story, what ended up happening is they had a great Christmas, spent it with family, everything was going well, and then all of a sudden in January, they get an urgent call, and essentially what happened is they had to come up with thousands and thousands of dollars right after they spent a bunch of money on, of course, Christmas time, presents, Christmas dinner, travel, etc. And the reason for that was to pay that quarterly estimated payment. The quarterly estimated tax payments are due January 15th, April 15th, June 15th, and September 15th, or whatever the next business day if it's on a holiday or a weekend, right? So in their case, they made the conversion in December, meaning January 15th was right around the corner, and they had to come up with cash fast. Nobody likes receiving that notice. And if, for whatever reason, their accountant or financial advisor hadn't been on top of it enough to let them know, then a possibly even worse result would have been that they still would have owed that money, but there would have been penalties on top of it. Because if you don't make your quarterly estimated payments that you would have owed, there's typically a penalty attached to it, and it's not small, especially in today's interest rate environments. So again, big mistake number 3, not taking into account the quarterly estimated payments or taxes that would be due and the timing of those taxes on Roth conversions, especially larger Roth conversions. All right, now I did promise you that if you stuck around until now that you would get a bonus, right? So that bonus mistake is mistake number 4, not taking action. I'm willing to bet that the majority of you watching this video have probably heard of Roth conversions, probably even done a good bit of research. This video is probably part of your research. You've probably even pulled up a few spreadsheets and plotted out, okay, what would that look like based on my tax bracket and how much I convert, at what age, and how many years I would need, etc., etc. What I have found is far more often than not the case isn't that people need to be convinced of how good a Roth conversion can be for their financial picture, but rather that because of this paralysis by analysis that they fall into, that action is never taken. They think, I'm gonna do it, I'm gonna pull that trigger, but there's this inherent fear that maybe they can't quite even put this picture on. And if this describes you, then I would love to hear from you. Because at the end of the day, not taking action on something can be a far greater regret than taking action, and yeah, maybe you make a few mistakes, or maybe it's not quite perfect, but you know what, at least you took some kind of action. Whether that's, taking that leap into small business ownership, or taking that leap into retiring early, or simply taking that leap into talking to a professional about a Roth conversion to see if it's right for you. At any rate, we'd love to hear from you if any of this rings a bell for you or describes something you've thought about before. Drop us a line, hit that contact link in the description below, and in the meantime, I'll see you out there.